Raleigh is a platform that changes the way we think about high-end assets by turning rare collectibles into securitized companies. It basically allows you to buy equity shares in things like vintage Ferraris, rare Pokemon cards, and even dinosaur fossils. Instead of needing hundreds of thousands of dollars to own a piece of history, you can get in for as little as $1 to $5 per share. The way the process works is pretty straightforward. First, the Rally team sources museum-quality items ranging from cars and watches to wine and memorabilia. Once an asset is acquired, it is turned into its own LLC and qualified by the SEC. During the initial offering or IPO phase, you can buy shares at a fixed price. After a lockup period of about 90 days, those shares can be traded on a secondary market within the app during standard market hours from 10:30 a.m. to 4:30 p.m. Eastern Time. If a third party ever makes an offer to buy the entire physical asset, you and the other shareholders get to vote on whether to sell, which gives you a real say in the final exit. There are some serious pros to using this platform. The diversity of assets is truly unmatched in the fractional space. You are not just limited to stocks. You can have a portfolio that includes a 65-million-year-old dinosaur skull, Andy Warhol paintings, or luxury handbags. It democratizes an investment world that used to be reserved for the ultra-wealthy. One of the best parts is that there are zero trading commissions on the secondary market. Unlike traditional brokerages, Rally does not take a cut when you buy or sell shares from other users. They also handle all the hard stuff like climate-controlled storage, 24/7 monitoring, and full insurance. You can even visit the physical assets at their museum in New York City. The app itself is polished and provides great historical data and professional photography, so you know exactly what you are putting your money into. However, you have to be aware of the cons because this is not a guaranteed win. The biggest issue is liquidity risk. This is not like the stock market where you can sell instantly. If there are not any buyers at your specific price, you might be stuck holding those shares longer than you planned. That 90-day lockup after an IPO is also a factor since your money is completely tied up for 3 months. You should also remember that collectibles are speculative. A sports card can lose 50% of its value overnight if an athlete's reputation takes a hit. These assets do not produce cash flow or dividends, and there are no guaranteed returns. You might also deal with high bid-ask spreads because the market is smaller, making it tough to exit at what you think is the market value. Plus, while insurance covers financial loss, physical assets can still degrade over time. Finally, when an asset is sold, corporate taxes and entity fees are taken out of the final price, which can shrink your actual payout. In my opinion, Rally is an incredible tool for passion investing and diversifying a portfolio that is too heavy on stocks and bonds. It is a great fit for the fan investor who loves the history behind these items or someone looking for a small amount of alternative exposure. But it is definitely not for short-term speculators or anyone who needs instant access to their cash. If you are a risk-averse retiree or someone who cannot afford to lose your principal investment, you should probably stay away. It is important to keep in mind that while there are no trading commissions, the inherent risks of speculative assets and low liquidity mean you should only invest money you are comfortable leaving alone for a long time. To summarize, Rally is a unique and engaging way to own a piece of rare luxury items with a very low barrier to entry and zero trading commissions. However, the risks are significant, including a 90-day initial lockup potential for high volatility and the reality that you might not be able to sell your shares quickly when you want to. Always weigh the excitement of owning a rare collectible against the very real possibility of price drops and liquidity hurdles.